name is Richard C. Cook. This is my new book, We Hold These Truths, The Hope of Monetary Reform. Welcome back to this 6-part video entitled Credit as a Public Utility, the Solution to the Economic Crisis. We are now at Part 3, Collapse of the Financial System. In Parts 1 and 2, we saw how the U.S. became a nation dominated by the financial elite in their privately owned banking system that introduces money into circulation by putting citizens and the government into debt. We also noted that the banking system is international in scope because it interlocks with those of other nations. Globalization means we are all economically interconnected, for better or worse. That's why America's Chinese creditors are willing to continue to finance our debt. They know we cannot buy their manufactured goods without their investments. But the system as a whole makes the international bankers the most powerful economic and political force in an increasingly unstable world. Let's now fast forward to the crisis we are facing in 2009. In order to conduct this survey, we need to understand that a nation really has two economies. One is the producing economy, where men and women go to work every day to create the goods and services we use in daily life and which provide us the jobs and income to purchase what we and our families require. The producing economy should also generate surplus income that can contribute to common needs through taxation, be saved for a rainy day, or be invested in better methods of work. The producing economy also includes the farms and factories in foreign countries where workers manufacture the goods and services that are exported to us. Often, of course, these workers earn much less than U.S. workers would by doing the same work. Note that nothing which has happened in this recession has made the world's producing economy any less able to provide for our needs. In fact, the efficiency and productivity of the producing economy grow all the time due to innovation and technology. Actually, the crisis started in the second economy, which is called the FIRE economy. This stands for finance, insurance, and real estate. This is the economy of banking, credit, investment, capital formation, lending, and borrowing that surrounds the producing economy like a blanket and should provide what is called the liquidity or working capital that allows the producing economy to function smoothly. But in recent years, the FIRE economy within the U.S. has grown much more rapidly than the producing economy. This is the root of the problem, because disproportionate growth of the FIRE economy means inflation, excessive overhead, profiteering, and corruption. It also means the debt pyramid that forms the basis of the monetary system will eventually collapse. The Federal Reserve is a key player in the FIRE economy, largely through its control of interest rates. Interest rates are extremely important because all the money that flows through both the producing economy and the FIRE economy ultimately comes from bank lending at interest. But that lending is easily abused. And when the interest is compounded, it grows exponentially and is an increasing burden on everyone who works for a living. For example, up to 97% of the money that traders use to purchase contracts in the commodities markets is not their own, but consists of funds borrowed from a bank. Stocks bought on margin use the same technique, where an investor utilizes a small amount of his own money, then borrows the rest. When equity funds buy entire companies, that too is done through bank loans. Obviously, all this can be a very risky game for investors, though less so for the banks because the money they lend is created out of thin air through their fractional reserve privileges. If borrowers go bankrupt, the banks can seize their assets, if they have any assets, of course. Today's crisis began within the United States through the excesses of the FIRE economy. Specifically, it was the bursting of the housing bubble that has triggered the worst crisis since the Great Depression. This bubble, which many had warned about, resulted from decisions made by the Federal Reserve System under Chairman Alan Greenspan after the crash of what is called the dot-com bubble in 2000-2001. In December 2000, around the time George W. Bush was being declared president over Al Gore by the U.S. Supreme Court, the stock market collapsed. Within a year, $8 trillion in investors' wealth simply disappeared off the books. In March 2001, President Bush asked Congress to pass a huge tax cut, mainly for the wealthiest investors. By the end of 2001, the U.S. government was responding to the 9/11 attacks by invading Afghanistan. They were also planning an invasion of Iraq. So, with no new economic driver on the horizon, the Federal Reserve decided to create a recovery anyway. So it cut interest rates by over 500 basis points. That's 5%, a huge drop, over the next 2 years. Remember, the financial reserve is the instrument of the financial oligarchy. But these rate cuts did not lead to a growth of industrial production. Instead, the financial industry began to provide mortgage and home equity loans to any customer able to walk through the door. So the price of homes skyrocketed through runaway housing inflation. Federal regulatory agencies looked the other way, and the housing bubble grew. Huge numbers of mortgage and home equity loans fed cash into the economy, cash created out of thin air. With the approval of the Federal Reserve, the banks now did something unprecedented. They packaged the increasingly shaky mortgage loans into bundles of mortgage-backed securities, making new financial products. Wall Street then sold these new products to investors in the U.S. and around the world. Later, these securities would be exposed as the toxic loans we have been hearing so much about. Meanwhile, the floodgates of other types of speculative lending by Wall Street and the banks had been opened in 1999 when the bankers prevailed on President Bill Clinton to repeal the Glass-Steagall Act, which had been enacted during the Great Depression to reduce financial risk-taking. The Glass-Steagall Act had prohibited commercial and investment banks from intermingling their operations. Now, the largest commercial banks could engage in the most risky and highly leveraged types of lending that previously had been illegal for them. Additional financial bubbles began to appear, not just in housing, but also in commercial real estate, equity and hedge funds, commodities, and the type of financial instruments known as derivatives. Derivatives are contracts made between parties that obtain or derive their value from their underlying assets. Those assets could be stocks, bonds, commodities, currencies, or even insurance policies. In fact, many financial institutions wrote derivatives based on their largest investment funds, totaling in the trillions of dollars. The government made another fateful decision. The Securities and Exchange Commission would not regulate these derivatives. In fact, no one did. What the bubbles had in common was that they pumped huge amounts of money, whose ultimate source was bank lending, into the economy, without any relationship to work actually being done by the producers of goods and services. So inflation naturally resulted. Homes, as I indicated earlier, escalated in price virtually overnight. This valueless inflation of the price of a family home by the Federal Reserve and the government was a crime against the working population of this country. People bought the homes using exotic loan instruments such as 0% down, interest only, or adjustable rate mortgages. Gasoline prices also shot up in this inflationary atmosphere. Stock market prices also inflated despite very high corporate ratios of debt to equity. The Dow Jones Industrial Average peaked at over 14,100 points as late as October 2007. This, too, was a bubble. The capital gains that sellers profited from when homes and other assets turned over substituted for the loss in income that Americans had been experiencing due to the outsourcing of jobs to other countries and to the wage-salary stagnation among the workforce that had been developing over the last 2 to 3 decades. This job outsourcing was the result of policies and decisions dating from the early 1970s. The job outsourcing and wage-salary stagnation had led to a steep long-term decline of real worker income, reflected in loss of consumer purchasing power and drop-off in savings, at the same time as profits from financial wheeling and dealing soared off the charts. Consumers whose jobs were no longer sufficient to meet their expenses had tried to join in the speculative carnival by treating their homes virtually as ATMs. It wasn't uncommon for mortgage brokers to rewrite a mortgage every other year. The broker got a commission, and the homeowner got a check for the increasing worth from the difference between the former and the new housing value. Homeowners were the big losers when home prices began to plummet, especially in previously high-growth areas like Florida, Texas, Nevada, and California. The bubbles began to burst when, during the period 2003 to 2006, the Federal Reserve reversed its previous policies, now by raising interest rates. You can see from this scenario how the Federal Reserve giveth and the Federal Reserve taketh away, just as our early presidents warned would happen if our monetary system was controlled by the banking system. Home prices were driven up by demand, speculation, and a sudden large-scale drop in interest rates that would have made monthly payments on the home seem very attractive. But the values of millions of homes have now fallen below what purchasers owe for them, a condition known as being underwater. Banks, meanwhile, have tightened credit because people can no longer pay their debts, and because so many homeowners are defaulting. Banks are making up for it by raising interest rates on credit cards and other types of loans. Huge financial institutions like Lehman Brothers or Merrill Lynch have gone bankrupt or been bought out by competitors. Millions of people are now losing their jobs, homes, and health insurance. Over 500,000 jobs are being lost per month, over 600,000 in February 2009. Real unemployment could exceed 20% in the next few months, if we count not only those receiving unemployment benefits, but also so-called discouraged workers no longer seeking jobs, and those who must take only part-time jobs. And government tax revenues are falling, leading to more job loss as state and local governments cut payrolls and services. Unemployment is starting to approach Great Depression levels. As we know, the U.S. Treasury Department and the Federal Reserve, through emergency action, have been trying to bail out the FIRE economy. Hundreds of billions of dollars have been pouring into the banks through the Bush administration's Troubled Assets Relief Program, with more money being added by President Barack Obama's new Treasury Secretary, Timothy Geithner. The bailouts began when foreign investors, mainly from Europe, told U.S. officials they would no longer purchase our risky securities. This was the trigger of the bank meltdown that took place in October 2008. So far, the bailouts have been used by the biggest banks to consolidate their dominance by buying out weaker, failing banks. But they have not restarted the stalled lending to businesses or consumers. The banks have also been hoarding the bailout money to offset their still unknown losses from bad assets. But new lending by the banking system and a renewed stream of debt within the economy is not the answer to the crisis. Our national debt load, money owed to financial institutions by individuals, households, businesses, and governments at all levels, is now about $53 trillion and has been growing by more than $3 trillion a year. Interest on the debt is running at $2 to $3 trillion per year in an economy with an annual GDP of $14 to $15 trillion. With the disappearance of so much wealth through the decline in housing and equity values, the burden of this debt has become much worse during the past 2 years. Faced with these circumstances, the Obama administration's new $787 billion economic recovery program is the largest spending bill in U.S. history. But the job creation elements are uncertain and the infrastructure provisions weakly funded. Spearheading the job creation will be an estimated 1 to 200,000 new federal government jobs, with an overall target of 3.5 million new jobs by 2010. But will this be enough? The government, under existing legislation, is able to do little to remove the debt that the economy is carrying, except to hope that by attempting to rekindle economic growth, the debt can be paid off. But it won't. The debt is much too big to be outgrown, even if consumers purchase far fewer items and save much more of their earnings. But this would mean less spending, leading to further job loss at home and fewer imports from abroad. So it's a downward spiral, both for the U.S. and other nations whose producing economies we have been supporting with our imports. How long will the downturn last? No one knows. What the Obama administration hopes is that the recovery measures contained in the bill passed by Congress will get us through 2009 without a catastrophe. What is not being done, or even discussed, is the type of profound structural change that would come about if the government moved to take control of the nation's monetary system. The only way this could happen would be if the people, us, demanded it in a loud, clear, and unified voice. Real monetary reform should go well beyond the government simply buying equity in the banking system in order to take toxic debt off the hands of the banks. Real monetary reform would eliminate the bank-run, debt-based monetary system altogether, and would be bitterly opposed by the financiers and their political supporters. But it should be done nonetheless, and it should be done now. Later, I will explain just how monetary reform would do this. Otherwise, though the government is starting to play a much larger role in the economy, the monetary system, with the banks in charge of money creation, will be the same as before. The financial elite will remain in control. But we can see from this overview that as long as the private financiers are in charge of the money supply, the economic life of every American will be squeezed to the point that the standard of living in this country must decline sharply. It is happening today across the nation, in cities, towns, suburbs, and rural areas. And it is happening around the world, because the ability of U.S. consumers to buy what workers in other nations produce is collapsing also. The level of desperation among people everywhere who are feeling the pinch is growing, and it is likely to get much worse. Unfortunately, the Obama administration has yet to challenge the financial oligarchy in its stranglehold on power, even as it tries to cushion the blow of economic hard times on the American public. The oligarchy says it wants a recovery, but not one that benefits working people. What they want is to rekindle bank and corporate profits. The thing to remember, though, is that nothing that has happened with the downturn has reduced the world's productive potential. The producing economy is just as capable as it ever was, if it weren't loaded down by debt and weakened by the continued export of our best jobs and industries. Our people are just as intelligent, just as able to work and create. It's the financial system that has betrayed America. The system has collapsed, as it was designed to do. Being a bank-centered system, it works on the basis of cycles of inflation and deflation that past leaders like Thomas Jefferson warned us about. For everything that is happening today, Jefferson and others foresaw, including what he said about our waking up homeless on the continent our fathers conquered. It is happening because of the banking system. If you talk to anyone who says otherwise, ask them 3 simple questions that will instantly expose their lack of knowledge and sincerity. 1. Why is the most productive economy on earth in a deep recession with so many jobs being lost? 2. Why is that economy $53 trillion in debt? 3. Why do we have to borrow money from China to operate our government? But to understand how we can survive the chaos now requires a deeper look at the nature of credit. We will address this topic in the next part of this video. Thank you for watching.